Hi everyone, it's Jamie here from the Wize Mentoring Network. Welcome to the next video. In this video we're going to talk about our business plan and our growth path. Now, part of overcoming the barriers to growth is to try and reach what your ideal turnover or fees are in order to reach your ideal income. So we're just going to revisit this ideal income calculator for a minute so that we can then put a plan together to know how we're going to reach the required turnover we need to have in order to have the ideal income. So in this example, let's just say that our ideal income is $500,000. So we're going to put in $500,000. The EBITDA that we think we can achieve is around 25%. And we think that we can get a gross profit of minimum of about 60%. So once we put in step 1, 2 and 3, we just need to go down and have a look at what fees we need for the desired income. So you can see from here that if we want a desired income of around $500,000, that our desired fees need to be about $2 million. And obviously with $2 million we need to have the cost of goods at about 40%, our GP at 60%, our overheads and expenses at 35%, and that will give us our EBITDA of 25% of $500,000. Now on the next sheet we're just going to go back and have a look at this business growth plan. Now this template is part of the Wize network downloads that you can use so that you can help determine the future path of your firm so that you can grow it. And the beauty of this template is it looks at your debt to equity, it looks at your LVR, and it also determines what your interest might be. So it's very strategic and very big picture. Now, in order to use this spreadsheet, we're just going to put in here that our future growth plans are, as we saw in the previous spreadsheet or template, $2 million. And we know if we have $2 million turnover, we can make it around about $500,000 EBITDA a year. We'll just say the current year is 2018, and let's just say, for example, that our current fees are around about $1 million. And for argument's sake, let's just say that we already have an existing debt in the business of about $250,000. The next step we need to do is we need to have a look at some realistic organic growth. Now when you're starting out in the early days, you know, if you return emails and return phone calls, often you'll grow at around 10% plus every year. Obviously it becomes harder as you get bigger to grow at that rate, so we're just going to be conservative, and I might just make it 5% every year. So we'll work our way down this spreadsheet. Again, you can see that in the current year we've got around about $1 million in fees, and we think we'll pick up from organic growth around 5%, which is $50,000. So let's not forget our goal that we need to get to $2 million. And you can see here, if we plot along at around 5% growth rate, we're not going to get to $2 million, you know, somewhere in the 2030s. And you can see that from the spreadsheet there of the accumulated growth of 5% each year. So what we need to do is we need to look at some tuck-ins and some mergers, and this is what part of what Ed taught me to do here at Sky Accountants, and we looked at different acquisitions, and it's really propelled our growth along. If we have a look at this, for example, let's just say next year we find a firm that has around $500,000 in fees, and the current owner doesn't have a succession plan, so you're looking at purchasing his practice. So we place $500,000 in there, and you can see now that we're getting up closer. Looks like we're going to hit the $2 million mark in around 2024. So in around 7 years from now, based on that. We might want to do it a little bit quicker because of time frames. So we might actually just push in perhaps another little tuck in here in 2022 of perhaps 250,000. And you can see there that in about 5 years' time, we can get to the $2 million mark, which will then also achieve our ideal income. So we'll just work our way through this spreadsheet. So we've got total fees, and you can see there that we pick up some really good growth rates in the years that we purchase some other firms. The additional debt comes through, 500,000 there and 250,000 there in 2022. The next line here is we've got our concept of our $1 million teams, and you can see there that once we get up to around 2 million, we can actually have two teams or two senior client managers, and they'll be managing around $1 million each. The growth per client manager is around 42,000, and that's simply to get about 5% growth each year. So you would think that it would be quite achievable with a good marketing plan in place that we can pick up new fees of around 42,000 each. Now the next part here is we need to put in our bidder, and we mentioned earlier that it needs to be 25%. If we're going to borrow funds from a bank, we also need to look at the interest rate that they might charge us, and so we're going to put in 8% there just to be conservative. The next part is if we borrow money from the bank as well, we'll need to repay that over a certain number of years. So we need to look at perhaps just 15 years to be a little bit conservative. Some people can go interest only, for example. The other part of this is we need to work out what a profit distribution is. So perhaps if we decide to distribute around 30% of our profit at this stage, and also the tax rate, we will have to pay tax to look at this from a cash flow point of view. So if we come back and revisit the first year that we've made our acquisition, the EBITDA, or 25% of our fees, is around about 400,000. The interest on the loans that we've got, which is the 500, and our existing debt of 250, is about 56,000. So that gives us a net profit there from a tax perspective of 344,000. Now if we just have a look at the cash flow effect, our debt repayment over 15 years is about 50,000. The profit distribution at 30% on the net profit is about 120,000. The tax there is 30%, which is about 103,000, and the cash remaining is 71,000, and we have an accumulative cash balance there of about 162,000. The final part of the spreadsheet is what our goodwill is worth, and you can see there when we make another acquisition of 250, it hits just over the $2 million mark. And we also have an accumulative balance of our debt less our principal repayments along here. So you can see there that when we do the acquisition, our loan to value ratio goes to 44%. It's a great idea to keep it under 50% for a bit of fat or equity in the business. And you can see there it steadily goes down, then it pops back up again when we make our next acquisition. Now if you like, you could always do a third acquisition in some years ahead, and you might, for example, put another 500,000 in there, and you can see there that again our asset jumps up, obviously our debt jumps up, but our LVR is still in a safe range there at 35%. So I hope you can use this tool and use this video in order to achieve what your ideal income is. And if you've got any questions, let us know, but by all means, take a day out, do a strategic planning day, and you can certainly use the acquisitions and the tuck-ins or mergers to help grow your firm to reach the ideal income that you need. Okay, bye for now.